Instead of taking the risk of just investing in Tesla or Apple, the QQQ ETF can give you great exposure to all the best tech stocks from just one place. Unfortunately, the Invesco QQQ ETF is a bit of a paradox. Depending on who you talk to, the QQQ ETF is an excellent investment that has made a lot of people a lot of money. However, on the other hand, the QQQ ETF is a terrible investment and has lost a lot of people a lot of money. Now, this might sound a bit crazy, right? As it's the same ETF fund. But in this video, I'm going to show you why this is in fact true. As this is a review, we will be looking at exactly what the QQQ ETF is, the pros and the cons, and whether it might be a great opportunity right now. As always, if you do find anything in this video useful, be sure to click that like button. That would be much appreciated, and every like does help. Okay, sit back and relax, guys. Here is what you need to know about the QQQ ETF. Okay, so this is what we've got coming up. We're first going to take a look at what exactly is QQQ. I'm then going to show you why this has been an excellent investment for a lot of people. But then I'm going to show you why this has been a terrible investment for a lot of people as well. And then we'll finish with a summary and any action steps. First up, a quick disclaimer.
This video is for education purposes only. You should seek investment advice from a registered professional before making any investment decision. This video is not responsible for any investment actions taken by its viewers.
What is QQQ? So this fund was created by Invesco all the way back in October 1999, and this was just before the internet tech bubble of 2000. It tracks the Nasdaq 100 index, and it's heavily weighted into tech stocks. There's circa 138 billion of assets under management now in this fund. There's approximately just over 100 different holdings. The expense ratio is pretty low at 0.2%, so that's good. It pays a dividend of 0.7%, and the fund is rebalanced on a quarterly basis. When it comes to countries, as you can see, the vast majority, 98%, is the United States. So this is pretty much a US fund. When it comes to the sectors, as you can see, it's heavily weighted into technology with over 63%. Next biggest sector is the consumer cyclicals with some healthcare as well. But as you can see, this is predominantly technology. As for the top 10 holdings, lots of companies that we all recognize here. So we've got Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, Adobe, and PayPal. And it's worth noting that just these top 10 holdings make up 56% of the fund. And if you look at the pie chart, you can even see that nearly a third of the fund is just made up of Apple, Microsoft, and Amazon. So this is a technology powerhouse. Now here is why it's been an excellent investment for so many people. So this is a chart showing the full performance of the QQQ ETF since inception in 1999. And just look at the growth that it's had. So first up, we're going to look at the last 10-year performance. So if you were lucky enough to invest around 2010, this is what you would have got. On average, every single year, your money would have returned you 45% per year, which is huge. So the fund has been compounding consistently at 20%, which makes it one of the best stock investments that you could have done in the last 10 years. Same thing again, but this time a little hypothetical. So In the year 2000, we peaked out in the dot-com bubble. And hypothetically, if you were able to invest at the absolute bottom, which was about 3 years later, then you would have had an 18-year average return of almost 70% every single year. And again, these gains, almost 70% a year, is huge for almost 20 years. And this is why this fund has made so much money for so many people. Next up, now I'm going to show you why it's been a terrible investment for so many people. This time, we're going to go back and see what happens if you'd invested in the fund at inception. So when it was first created in 1999. So this was in the middle of the tech bubble, the dot-com boom, where tech stocks were going through the roof. The stock market had been going up year after year after year. Everybody was making money. Everybody was jumping into the market. This fund was brought onto the market, which then pulled together all the best technology companies. Life couldn't be better. Everyone was making money, but then the bubble burst. The Nasdaq went on to lose over 80% of its value. As an investor, most people would have sold when it was crashing down. But if you managed to hang on to those stocks in this fund, you would have had to wait until 2014 before you even broke even. You would have had to wait 13 painful, long years before this fund began making money. In fact, because you're paying a 0.2% expense fee, you're actually losing money for 13 years. So most people would have sold and lost a lot of money, and a lot of people did lose a lot of money, or if you hung on, you'd have had to wait 13 years to break even. And one last hypothetical. So let's say you were unlucky enough to invest at the peak of the dot-com boom. In this scenario, you'd have had to wait to 2016 before you broke even. So 16 long, painful years before this fund began making money. And this is why, depending who you talk to, this could have been a terrible investment. And many people have lost a lot of money with this fund. So the big question is, well, what is the fund going to do for the next 10 years? This is the million-dollar question. So I'd like to introduce you to a ratio chart called the Buffett indicator. So what exactly is this? The Buffett indicator takes the combined market capitalizations of a country's publicly traded stocks, and it divides it by its quarterly GDP, gross domestic product. So investors use this ratio to gauge whether the stock market is overvalued or undervalued relative to the size of its economy. And Warren Buffett said, this is probably the best single measure of where valuations stand at any given moment. So this chart is going to show us whether the stock market is basically overvalued or undervalued. And here it is. And this is a nice macro long-term chart going all the way back to 1950 up to today's date. And you'll see it's a series of peaks and troughs. It peaked out in 1970. We had the dot-com bubble of the year 2000. And these were the times when the stock market was massively overvalued. And the stock market did do either a big correction or a big crash. Now, the big red flag right now, guys, is that the Buffett indicator is at an all-time high. When the ratio goes above 100%, the stock market is massively overvalued. In more recent times, it's only done this in the year 2000 with the dot-com boom. It did it in 2008, but right now, this is saying that the stock market is massively overvalued. So here's my summary. I personally really like QQQ. And for any people watching in Europe, the ticker symbol for this is actually EQQQ, if you want to search this on your broker apps. It does give you great exposure and diversification to technology stocks. And a lot of these companies are excellent. It has a really low fee of 0.2%, which is great. But as you saw, it's incredibly important when you buy. This ETF can be amazing or it can be a terrible investment. The Buffett indicator is showing that the stock market right now is extremely overvalued. So this is my word of caution. So for me personally, this will go onto my watch list. I definitely do want to own this fund, but I can't justify buying it at these levels. So I'll personally be waiting for a big correction or bear market to make sure I get a great entry point. So there you are, guys. You now know why the Invesco QQQ ETF can be one of the best investments or worst investments you can make. I personally think it is a great ETF where you can get exposure to companies like Tesla, Apple, Amazon, all from one place. However, when you buy is crucially important, as you saw. For now, it's on my watch list and I will be looking for a great entry point into this ETF. But as always, please do your own research. Okay, so I just have one favor to ask. If you did find anything in this video useful, be sure to click that like button. It would be much appreciated and every like does help. If you haven't yet subscribed, be sure to click the subscribe button and join us. I do have some great videos coming up that you don't want to miss. And if you've got any questions or comments, just post them below now. Okay, cheers guys. Thanks for watching and I'll see you in the next video. Bye for now.